Clear to us that the management of Lehman Brothers was spending an awful lot of time with at least one other firm going through due diligence. And so we got off to a slow start.
That was because Lehman's was giving its attention to that other suitor. Bank of America was the favorite to buy the ailing investment house. There were highly profitable parts of Lehman Brothers, like the investment division, which they wanted to salvage. But when its advisors started going through Lehman's accounts, what they found appalled them.
I have to say that although we were expecting not to be very happy with what we saw, it was worse than what we'd expected.
They calculated the property crash had left a massive hole in Lehman's balance sheet. Just a month before, the bank had said its portfolio was worth $40 billion. Now it had fallen to around $25 billion.
They might have paid $100 million for a property, and on their balance sheet it says it's worth $100 million, but the reality was it was worth $50 million or $25 million. And when you start adding all those losses up from this property and that property and so on, it ended up adding up to a very big number. A number that was so large, the losses were so large, that it really meant the company was bankrupt unless it got support from the U.S. government.
But the man in charge of the U.S. Treasury, Hank Paulson, had already made clear that was not an option. What happened next took everyone by surprise. The following morning, most New Yorkers were oblivious to the drama playing out down in Lower Manhattan. And as the morning went on, the stakes got higher. Dick Fuld was still counting on Bank of America making him a proposal, but was about to learn that his suitor had a roving eye. John Thain, the chief executive of Merrill Lynch, was the new kid on the block, but he had his own problems. Merrill Lynch's share price was going down because investors were selling, fearful of how exposed this bank also was to the property slump. So when he returned to the Fed on Saturday morning, he took a particularly close interest in the predicament facing his rival. Watching Lehman's representative wilt under the pressure, he began to fear attention might next switch to his own troubled bank.
Seeing him and understanding the emotional drain of what was happening to him, and then knowing that on Saturday that it was likely they were going to go bankrupt, so all of their efforts were going to fail, in some ways reinforced with me, I didn't want to be that person a week later.
So he grabbed the chance to save his own bank.
And so from my perspective, the problem no longer became how to save Lehman, because I assumed Lehman was going to go bankrupt. It became, what does that mean for the financial markets, and what does that mean for Merrill Lynch, and how do I make sure that I protect Merrill Lynch's shareholders and Merrill Lynch's employees and Merrill Lynch's clients so that, Merrill Lynch isn't in a similar position a week later.
He decided to contact Bank of America's chief executive, Ken Lewis, at home in North Carolina, and made him an audacious offer.
I stepped out of the building and actually stood on the sidewalk on the street and called Ken from my cell phone. The conversation was relatively short, and I said to him that I thought it made sense for us to explore some strategic options. He said, great, I can be in New York in a couple of hours.
All bets were now off. It was everyone for themselves. As Bank of America's boss was flying north on his secret date, Dick Fuld had no idea he'd been dumped. Excluded from the Fed, he had spent the morning holed up in Lehman's Midtown HQ.
Dick would occasionally ask, have you heard anything back from Bank of America, because we still found it difficult to believe they had disappeared. And the answer, of course, was always no.
Just a few blocks away, John Thain began to hammer out a deal with Bank of America's chief at a discreet hideaway by Central Park.
It was a corporate apartment, so it was not that different from a hotel room, and it was pretty stark. And it was just the two of us, and it was just the two of us talking.
To Ken Lewis, Merrill Lynch was a much more attractive proposal. It was proof of the Wall Street maxim, kill or be killed. By late afternoon, the jilted Lehman's team were trying hard to put on a brave face.
I guess late Saturday afternoon, there was a slip of the tongue in a meeting that I was at the Fed, which led me to conclude the Bank of America was definitely talking to Merrill, as well as my inability to get calls returned. So I called Dick and said, I'm very worried this is accurate. And he said, I can't believe it. And there was an adjective, which I will not repeat, or an adverb, I guess, before believe it.
It was a whirlwind romance. 2 days later, Bank of America announced it had bought Merrill Lynch for $50 billion.
The combined company is a much stronger entity and will survive most anything.
So, having been stood up, Lehman now had only one potential suitor.
As mid-afternoon on Saturday came, we had a very positive sign. We got moved into a much bigger conference room in the Fed, and there was a sign on the door that said buyer. So we had a feeling that one of the other banks that had been looking at the transaction probably wasn't there.
The teams from Barclays and Lehman were edging closer to a deal.
The man nobody wants to be right now is the longest-serving CEO on Wall Street. Dick Fuld faces his biggest challenge to date by far.
Still up in his midtown office, just along from Times Square, Dick Fuld was now a helpless bystander as others decided the fate of the bank he had led for so long.
Now all the hopes rested on Barclays. So it was a real disappointment, but it was buffered to some extent because Barclays seemed a lot more interested than they had previously.
How different it all seemed 9 months earlier. Lehman Brothers was celebrating the end of a record-breaking year. It made over $4 billion profit. And the reason for this success? Bricks and mortar. Both Presidents Clinton and Bush had championed home ownership.
Our government is supporting home ownership because it is good for America. It is good for our families. It is good for our economy.
American house prices had risen steadily since the Second World War, but had rocketed after 9/11, when interest rates were slashed. The boom was fueled by loans, with tempting introductory rates being offered to ever more risky clients. The so-called subprime mortgage scandal was born.
We got to the point where they created mortgages that were known as ninja mortgages, no income, job, or assets, relying solely on the appreciation of housing prices.
Mortgage rates are still near 20-year lows.
Homeowners, refinance now with almost no paperwork.
If you're a homeowner who's ready for some financial relief, we'll even give you a free credit report when we...
But the real money for Wall Street banks came not from selling mortgages to homeowners, but from trading bundles of these loans among themselves and other institutional investors.
It's that easy.
These bundles were labeled as high-quality, low-risk assets by the banks.
$4 a month.
By 2007, Lehman's was the largest underwriter of real estate loans in America.
It was a great machine. The risk involved in the machine was that investment banks were supposed to act as distributors. They were supposed to be in the removal business. And Dick Fuld used to say this, we're in the removal business, not the storage business.
Across Wall Street and in the City of London, there was a growing assumption the financial wizards had been able to eradicate risk.
Okay, Mommy, I'll take the house.
I think there was a general view around the marketplace that the sophistication of 21st century financial markets had enabled different sorts of risks to be taken by people who really knew what they were doing. There was, if you like, a bit of a fool's paradise. That was not specific to Lehman. That was a market belief that somehow or other everyone had cured the problem.
And that false sense of confidence led Lehman Brothers to do something other more cautious banks shied away from. It borrowed more and more money. By August 2007, for every $1 the bank owned, it was borrowing up to $44. It's called leverage. Whilst most of their competitors, like Goldman Sachs and Morgan Stanley, had a leverage ratio in the 20s or low 30s, Lehman's was much higher.
When I got to Lehman, our leverage was like 20-1, and when I left it was 44-1 top max, and that means that we have a relatively small amount of capital relative to the amount that we owe. It's 44-1 real dollars that we have, and massive dollars that we owe.
It used this borrowed money to play the property market. By 2007, it was investing $60 billion in commercial property, hotels, shopping centers, and residential developments around the world. But while leverage multiplies profits when prices go up, it also multiplies losses if prices fall. And that's what happened in 2007. Why? A growing number of the people who had been seduced by those cheap introductory mortgage rates couldn't keep up with the payments when the rates increased. Repossessions rocketed, and house prices slumped. The subprime crisis exploded on the world. Welcome to Bakersfield, California. It's not quite the kind of place one would imagine as a luxury destination. But that's what Lehman Brothers hoped it would become. It loaned $78 million to a developer with plans to build thousands of new homes in the scorching Central Valley.
Just heard about it. It wasn't a large focus on the desk, but you thought to yourself, "Geez, this is a little aggressive for a firm our size."
The advertising promised McAllister Ranch with its golf course, man-made lake and beach, and beautiful homes, where dreams become reality and where the good life truly begins. But this oasis was a mirage. Nothing beside remains. It's a victim of Lehman's bankruptcy and the downturn in the property market.
Here's a picture of the lake, what it was supposed to look like when it was finished. Another picture is someone enjoying the lake. We were contracted to build block walls around the project. I believe it was close to 20 miles of wall if we were to finish the whole contract. As you can see, the walls are quite long. That wall right there is approximately 3 miles long.
John Scripter is still owed around $1 million for unpaid work. It was the decision to invest in commercial developments like these that was to be the tipping point for Lehman Brothers. The bank invested aggressively in the property market at its peak, but couldn't get out before the crash.
In essence, Lehman loans money to McAllister in the short haul and then tries to syndicate and sell the syndicated loans globally. And when you can't sell it and share the risk, then it becomes a lead weight on your balance sheet over time. We really just didn't have that much bread, that many dollars to hold on to an asset like this over a longer period of time. It really became a lead weight.
And to Dick Fuld, the architect of Lehman Brothers' grand designs, that lead weight must have seemed heavier by the hour as the weekend ticked away. Sunday morning in New York started with a sense of optimism. The favorite, Bank of America, may have walked away, but Barclays was still in the game. As a precaution, Lehman Brothers had called in America's most famous bankruptcy lawyer, just in case the unthinkable happened. But even he thought a deal would be struck before the day was out.
When I came down Sunday morning, as I was driving down, I was thinking that I might be out about 3, 4 in the afternoon.